Are we in the midst of an enormous tech bubble, Pete?
I think that we are in the midst of certain sections of tech that are definitely in a bubble right now, Scott. There's no doubt about that. I mean, we look at some of these names that have absolutely soared to the upside. We all know those names. I mean, Zoom would be obviously the poster child, but you go across the board and you look at these names and you say they're in the right place at the right time, but are they really fairly priced? Or are they a little bit in that bubble area? I think many of them are, but right now, Scott, it's about growth, and there has been growth, and there has been cash. And we talked last week, we heard Rick Reeder last Friday. He was on the show, and he was talking about, you know, PE, obviously he still looks at that, but there are other elements that you're looking at as well, and you're looking at growth, and you're looking at cash flows and some of those types of things. So I do look at this, and I do see some names. There's no doubt about it. There are names that are up in the stratosphere, but I don't know that you could say that about all of tech. I think there are some tech names that have stretched up a little further than they had in the past. We look at a name even like tonight, we're going to be talking a lot about a name like Microsoft. We're going to talk about Apple. We're going to talk about a lot of these various names where the PE levels of these names is definitely higher than they had been in the past. But they're also in the sweet spot, so they've got growth. And if they've got enough growth, Scott, I think that makes up for the fact that maybe they're a little bit more in a higher area of a PE structure right now versus a lot of these other names where we see names that they don't even have a PE because they don't have profits yet. And those are the ones that I think do stand out for me, and those are the ones that I'd put in the category that Einhorn's referring to.
All right, so let's talk about these. Josh, you know, Einhorn says what matters in a bubble is not so much valuation, it's almost irrelevant. It's the psychology around the whole environment. Pete mentioned some of the stocks that we're talking about. I'm not suggesting by bringing up any of these names that these are the ones that Einhorn is most suspect about, because, frankly, I have no idea which stocks he talks about, as he says that they have adjusted our short book accordingly, including adding a fresh bubble basket of mostly second-tier companies and recent IPOs trading at remarkable valuations. Again, I don't know what stocks those are. I'm just going off of what Pete was suggesting. Zoom up, you know, almost 700%. It's not just the valuation you call out, but the psychology of saying, hey, I know why this stock is up, and it's justified because we're in COVID. Who knows what it's going to be like on the other side? So who cares how fast this company is growing? It'll grow into its valuation one day. Is that valid? Is it reason to worry about where some of these stocks are?
At first, I was like, oh, no, not another bubble, another tech bubble, because I'm old enough to remember the last few tech bubbles. And I was in the audience at Iris Own when David Einhorn unveiled his first bubble basket. And it wasn't in 2016. It was in 2014. It was in April of that year. So we're talking about 6.5 years ago. And Amazon was in his bubble basket. He was just shorting the stock. So let's look at what happened since. First of all, the whole XLK is up 250%, blowing the doors off any other sector in the market by far. Second, Amazon is up about 850%, and I know that he didn't remain short it the whole time, thank God. But Amazon's earnings are up 6,700%, and the trick is there weren't any earnings then. So they were earning $0 a share, and earnings, obviously, on a trailing 12-month basis have grown substantially since then. So everything that you're saying about, just generally speaking, these second-tier, quote, second-tier technology companies, you could have said the same thing 6.5 years ago, and in fact, he did. Now,
and let me stop you real quick, and you can continue in a second. He does, in this letter, admit they were wrong in 2016 when they identified what they thought was the bubble. I know you cite 2014, but I'll just say 2016. I understand that.
Right.
He does admit they were wrong. He looks at the environment that it exists today and says not only is it a bubble, but it's an enormous tech bubble. I bring you the rise in stocks of some of the ones that we mentioned as to why perhaps he's thinking that.
Yeah. So investors have not been valuing stocks on trailing 12-month earnings or price book or any of the metrics that a lot of experts on an earlier version of the world used to care a lot about. Investors are valuing companies on how much of their total addressable market they can capture and then start earning profits from. And if you had been investing on that premise for the last 6 years, last 8 years, you've done pretty well. Now, where I agree with David Einhorn, and I have always said whenever we discuss his ideas that I think he is one of the must-read investors, and I read all of his letters. Where I agree with him is that, yeah, there are a lot of recent IPOs that are unproven but have gotten these massive multiples because what they're doing is exciting and there is a ton of sales growth. It's not completely unfounded, the enthusiasm for these companies. And here's where you're going to run into trouble as an investor. If you take these companies' word for it that they're going to own their TAM, and they can't obviously all own their TAM because many of them compete with each other, then you're making the bet that they won't have a periodic stumble. I talked about Fastly last week being a very important situation for the market. I got laughed at by Weiss for a change, but the truth is that's exactly getting to the heart of what David Einhorn is saying. You have a company like Fastly, it's selling at 50 times sales. There is no room for a stumble. And they didn't even have a bad stumble, but the punishment in that stock could be a preview of what you end up seeing in electric vehicles, in solar stocks, in SPACs of every stripe, in semiconductor names, in workplace software names, work from home. You're going to see more Fastlys. I think he'll be right. We don't know what names he's talking about specifically.
Right.
So it's really hard for me to say I agree or I disagree.